From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB. Wonderful to have you join us either live on ausbiz.com.au or if you're listening in podcast form. Really nice to be here with you. I'm Nadine Blaney. Cheers to a Friday. Juliet's not here. She'll be back next week. And I'm not drinking alone, for the record. We do have a bottle going around the AusBiz newsroom just to mark what's been a pretty big week. Look, here locally, we didn't have huge economic data, but we did get the RBA minutes. I'll chat with my guest, Shane Oliver from AMP, about that one. But we have had a lot happening on, the geopolitical front, a lot of elections going on, and that includes today with that UK Labour landslide victory. The pound, though, remarkably calm in the face of what was an absolute wipeout for the Conservative Party. We've seen Asian stocks scaling new record heights in some regards. Japan's Nikkei and the Topix both coming up to record levels. So those are our key themes as we watch this market close, down by about 0.2% right now. We still have a few trades going through the S&P ASX 200, so we'll keep you updated on how the market finishes. But yeah, that landslide victory in the United Kingdom, one that we'll be watching elsewhere. We saw the US dollar slightly weaker, Treasury yields marginally higher in Japan, but the Aussie dollar up above that 67 US cent level. I had a good chat with Mahjabeen Zaman from ANZ. She's the head currency strategist, I forget her absolute correct title. But anyways, we've got that interview up online if you'd like to take a listen. She's calling for the Aussie to hit 69 cents by the end of the year. So this is the highest the Aussie has been for this period of time, for such a long time. It's been up around this above 67 cents for more than 24 hours. On the flip side, though, we've got Bitcoin coming under quite a lot of pressure. And we spoke with John DeWett from ZeroCap a little bit earlier today. Andrew had a chat with him. That's up online as well if you'd like to have a listen, ausbiz.com.au. He talks about what could happen to Bitcoin under a potential Trump presidency. Of course, we heard from the US President Joe Biden today at July 4th celebration saying that he's not going anywhere. So watch the news flow over the weekend on that front, because there's a few Democrats getting quite hot under the collar when it comes to his ability to manage the campaign. All right, well, let's get to some of the sectors of the day to see what led or lagged this market. It was the big banks, in part, that helped drag down this local market. So we did see, the likes of CBA coming under a bit of pressure. We saw 6 of the 11 sectors coming under pressure today. The financials, the materials. CSL, though, did lift the healthcare sector higher. So we'll leave that there and get to some of our top corporate stories, with Suncorp finalizing its reinsurance program for FY25 and the sale of its banking business. It's confirmed. So this time last week, it was given the green light by the Federal Treasurer, Jim Chalmers, saying it was in the national interest for that merger or takeover to happen. So Suncorp today saying that will happen by July the 31st. Suncorp shares today up by 0.3%. Really, other than that, there wasn't a lot of big news. When I take a look at, the big share price movements today, it really doesn't come on any big corporate news. A lot of it is sort of broker moves that have pushed things around. It's just one of those Fridays ahead of reporting season, right? Interesting to note, though, that Clinuvel Pharmaceuticals, its share price has taken a big leg up after positive study results evaluating the DNA repair capacity of one of its skin treatments. And the Australian court, it's declared a term used by PayPal Australia in its form contract with small businesses to be unfair. We'll leave that one there. Let's get to my guest, Shane Oliver. He is from AMP. Hello, doctor. Hope you're doing well on this Friday afternoon. Okay. What do you make of the UK election result? Will we be talking in some time about Britain returning to the EU, or what can we take away from it here in Australia?
Well, to be honest with you, I don't think it has major implications for Australia. It's good to see UK getting back to some more stability. There was a very resounding win for Labor. It sets them up well for the next 5 years, but this is also not to deny the challenges the government faces there. I think it was Deputy RBA Governor Hauser last week saying that we complain about things here, but they've had virtually stagnant per capita GDP or living standards since the GFC. And obviously trying to turn that around is not going to be easy. I think the good news is that the new government is not a hard left iteration that we might have got 5 years ago under Jeremy Corbyn. It's more focused on realistic objectives of trying to boost growth, but obviously that's going to prove challenging. To be honest with you, I think one way to boost growth would be to go back into the European Union and the free market, but I think it's going to be very hard to achieve that in the next 5 years. It's not impossible, but I wouldn't think that that's on the cards. But overall, I don't see major implications for Australia. I think the French election, to be honest with you, is far more significant for financial markets than the UK election will be.
Okay. We'll go to the US elections then, because as I mentioned, Biden saying he's not going anywhere. Trump, obviously, he's got his fighting gloves on, particularly since the Supreme Court overturned that decision earlier this week, saying that he can, in fact, be above the law, I suppose, if you want to summarize it like that. Do you think that a Trump presidency would be bad for risk appetite?
It could be. There is a lot of risk around Trump. This would be his last term unless he becomes dictator and overrides the limit on having 2 terms. And if it is his last term, then he doesn't have to face re-election. Therefore, he could be a lot tougher this time. He could be more gung-ho in terms of what they want to do. Those polls, interestingly, are quite stark in just showing how different the situation today is compared to this time 4 years ago when Biden was well ahead of Trump. That's the sort of the teal-coloured line. And, of course, this time Biden is well below Trump. And, of course, when you look at the betting markets, way ahead for the Republicans relative to the Democrats. The problem with Trump, on the one hand, you can argue, well, he's promising deregulation and lower tax rates, particularly for corporates. Share markets like that. The only problem is, and we know from 2018, that share markets don't like trade wars. We had one of those in 2018. This would be a much bigger version, given he's proposing 10% tariff on all countries, includes us, and 60% on China. That would obviously set off retaliation and go well beyond what he's dreaming might be the case. And it also makes it a more inflationary world once you start restricting the flow of imports and competition, then that results in more inflation like we had into the 1970s. He's also talking about, or potentially talking about, a less independent Fed and maybe less immigration, a big cut back on immigration, which would potentially boost labour costs in the US. So all of those things are potentially inflationary, potentially also lead to a bigger budget deficit than it already is. And that could be seen as a problem and as a negative for markets. A lot depends on what he does first. In 2017, his focus was on tax cuts and share markets cheered that. Then, of course, he turned to tariffs and share markets weren't so happy in 2018. In fact, the US share market almost fell 20% from its high earlier in the year to its low on Christmas Eve. And so we don't really want to see a repeat of that, but that is certainly a risk under a more gung-ho Trump, potentially. If he's sort of, the Trump we saw the other day on the debate, much more presidential, maybe more considered, then it might be a different story. But if he's anything like he was 4 years ago and implements some of his more radical policies, then you will see, I think, negative reactions in investment markets.
All right, but for now, we are still ahead of that. And share markets mostly rose over the past week, and that included our own. So what did we have going for us, Shane?
Look, I think it was a bunch of things supporting markets. In the US, you're getting this ongoing drip feed of slower economic data. That's fueling expectations that the Fed is on track to cut rates. It's almost fully priced in, I think fully priced in for the first cut in September. So we're getting back on track on that front. The Fed comments from Powell earlier in the week out of Sintra are positive in that regard. So, and then, of course, you've got renewed strength in tech stocks Nvidia is yet to get back to its previous high, but it has been trending up, and tech stocks generally have been doing pretty well. So that's keeping things going. Obviously, there is anticipation of the profit reporting season in the US. The consensus is for profit growth of, I think, somewhere between 7 and 8%. Odds are it'll be another 10% profit growth reporting season, as it has been for some time, and that is supportive. In Europe, I think there was a degree of easing of fears regarding the French elections after the first round, where the National Rally didn't do quite as well as expected. And now, of course, we've seen lots of candidates in races where there's three candidates, or triangulars, I think they call them in French, or something like that. You're seeing candidates on the left or the centre pulling out to consolidate the vote against the right. This is the so-called sanitary cordon that they put around the far right. So that all suggests that yes, we'll probably see the National Rally get the most votes and probably get the most seats on Sunday in France, but it may not be enough to form government, and that, of course, has enabled a rally in Europe. Japanese shares record high when I last looked earlier this morning after a period of consolidation. The Aussie share market was dragged up by all of that. I don't think there was anything particular locally that was fantastic one way or the other, but we did get a bit of a pull-up. Interestingly, though, when I look at our market over the last week, you did see big gains in resources, property stocks, and I think the rest of the market was pretty so-so. So it was fairly narrowly based, this rally that we have had. Obviously, energy stocks benefiting from the rebound in the oil price.
Yeah, and coal got a leg up to start the week, if you recall, from that underground mine fire happening at Anglo American up in Queensland. There was also a rail derailment or collision that happened the week before, which helped drive those prices higher. So will the US jobs report upset the apple cart tonight?
Well, it has a habit of doing that sometimes. I find these numbers a bit random, a bit like our own labour force data. You sort of go into it and it's all over the place, and then next month it reverses. Market consensus, 190,000 payroll jobs, down from 270,000 in the previous month. So that would be consistent with a slowing. Unemployment staying at 4%, up from its lows, and wages growth slowing down. So that's pretty much the consensus. Odds are it will probably be roughly in line with that, but and certainly when you look at forward-looking indicators for the US labour market, the employment components in the business surveys like the ISMs, the job openings, they rose a little bit, but you struggle to see that. The broad trend is clearly down. Less people quitting jobs for new jobs. Continuing claims heading higher, which means that even though we've still got low initial unemployment claims in the US, once you lose your job, it is getting harder to find a new job. So all of those things, I think, are telling us the US labour market is cooling. And in particular, the wages numbers tonight will probably show wages growth back below 4%, which the Fed would be quite happy with. So time will tell. Yes, as I mentioned, it is a bit of a random one as to which way this one goes, but I think we are heading towards a cooler market. Labour market in the US. The big worry I would have to say is, so far, bad news is good news. Slower economic data is seen as good news because it means Fed can cut. Obviously, a risk is that we don't see too much bad news, because that would mean the US is sliding into recession. And that's obviously probably one of the biggest risks on the horizon, that recession, long-delayed recession in the US finally arrives. Not our base case, but it's certainly a risk worth watching.
All right, Shane, look, it was a good chat. I think we've covered most, except for that last little paragraph in your weekly note where you're talking about share markets and happy music. Can you just give us the explanation?
Yeah, I saw a study by Deutsche Bank through the week. They'd gone through lots and lots of financial journals, economic journals, and picked out many articles which related to an analysis by academics of finance and things. And one study, this was from a Journal of Financial Economics from 2022, so a couple of years ago now, showed that there was a positive correlation between share market returns on the one hand and music that people listen to. So if the music that people are listening to that's popular at the time is positive, has upbeat tunes or upbeat lyrics, then share markets are more likely to be up, and at the same time, bond returns are more likely to be down. In other words, it's consistent with a safe haven situation. When it's negative music, bonds are rallying and shares are in the dog box. So that is an interesting finding. It doesn't necessarily, correlation is not necessarily causation. So just because people are listening to positive songs doesn't necessarily mean that that's causing the share market to go up or vice versa. But it is interesting that the two go hand in hand. You've seen various indicators like this over the years. I think in the 60s they used to look at women's dresses hemlines. I think that one only lasted for a little while when the miniskirt was very popular. And it always struck me as a rather sexist way of looking at things. But nevertheless, you can see that when society is feeling more ebullient, listening to happy songs, then shares do well. When that's not the case, then shares don't do so well. So we've got to keep listening to happy songs.
Well, yeah. Or the market needs to keep rising so we feel like listening to happy songs, chicken or egg. Right. Hey, did you see that performance by Michael J. Fox on stage with Coldplay at Glastonbury?
Unfortunately, I missed that.
Oh, no. Okay. Google it. Watch it on YouTube. You're going to love it. You will love it.
Sounds
okay.
Good.
All right. Shane, have a good weekend.
Good. Well done. See ya.
Shane Oliver there joining us from AMP for the weekly wrap-up. All right, let's get to our stock of the day, which was Suncorp. It's a buy for Jonathan Takadina and Gary Glover. They picked the eyes out of the technicals on this stock.
Suncorp's in the right sector, and there's tailwinds behind it. I just don't see inflation hitting that government target of 2% anytime soon, and I think they'll just keep raising prices into the future. So Suncorp, I'm quite bullish that, and that whole sector in general.
So you would have a buy on it?
Yeah, absolutely.
I'm a bit of a hold there. I just don't see on these multiples, and with all the good news they've had, and they've had a massive run up here. It's Suncorp and IAG have almost had this really, really strong run, and then actually popped into these sort of highs as well. So I think I just can't see where they're going to gains are going to come from. I think there's other opportunities elsewhere in the market. I just think these things are sort of not priced for perfection, but they're priced on the very high end at the moment of where they normally trade at. So, so I'm not sure the catalyst is going to come off there, but to me, they're a bit of a hold here.
So one buy, one hold for the stock of the day. And you can find all of our library of stock of the days, if you'd like to call it that, on our website. You just go to the top bar and look under series, and you'll also find this latest edition of the Investment Committee there. Of course, it went live on Tuesday. I know a lot of you like catching up with that one over the weekend. So what's in the fantasy portfolio, what's out of the fantasy portfolio, you can find that online. Look, let's get across some of the market leaders today. West African Resources, Judo Bank, they were out with a small to medium-sized enterprise report today. I spoke with Warren Hogan about that one. He's calling for 2 more interest rate hikes. Shane Oliver, who we just spoke with, is not. He still says that rates have most likely peaked, but Warren says the real determinant will be how many of us spend our tax relief that came through to start the week, how much of it will make its way back into the economy. Magellan, a second day, we've seen it on one of the best performers, Helios, and Red 5, they're closing up by 3.4%. On the flip side, Boss Energy is off by about 6%. Price target cut from Jefferies. Morgan Stanley also cutting its price target, keeping, just investors on the sidelines today. Seven, it's seen its price target cut to $43 from UBS, so still a ways to go if you believe what's on screen there. And Centuria Capital is off by 3.3% as well. John Ling's group, I don't know of the news associated with it, bit of a change in directors' holdings, and De Grey Mining is also on the list. It's seen its price target cut by UBS. In the small to mid-cap space, let's see what's resonating here. Biome had a good week, actually. It's up by 9% today. Flipping the page to see what lagged in the small to mid-cap space. And we've got Melbana Energy off by 8%. And E-Road. E-Road had a big share price gain. If it wasn't yesterday, it was the day before, so giving some of that back today. Tonight, what's on the agenda? We do have retail sales in the Eurozone. We hear from Williams from the FOMC, and we get the Fed's monetary policy report. And in Canada, the unemployment rate. What we'll be talking about next week? Well, yeah, the big one comes from NAB on Tuesday, the business confidence read, the monthly consumer confidence from Westpac as well. We get inflation expectations. We get U.S. Fed Chair Jerome Powell testifying at the Senate banking and German CPI. We also get Chinese inflation, which is an interesting one that we watch very closely here. All right, don't forget you can catch up with anything on our website over the weekend. I did have the chance to sit down with our former RBA governor and current chair of FutureGen, Philip Lowe. We talked about his passions now that he's stepped away from the institution where he worked for 43 years and what he sees as one of the biggest risks to not just the Australian economy, but Australian society as well. It's up online. You can find it there under Editor's Pick. Time to wrap it up. Thanks for a great week. Thanks for watching. I hope you have a great weekend, and we'll see you at 9:45 when we're live on Monday morning.